Hello, I'm Gary Korolev with Sovereign Wealth Management. Given the market action this last week, felt like it's a good time to comment on how we're positioned in the market and what we think is happening. So we take a look at the Consumer Price Index, the CPI numbers. About 2 weeks ago they came out and they were up another 1.3% to another high in decades. If you look here, overall we're at 9.1% rate of inflation, and you see the energy being the biggest contributor at 41.6% increase over 12 months. And so that prompted the Fed to continue increasing rates, where they raised this week by another 0.75%, which of course continued to tighten the market, tighten liquidity in the markets. Now, the Fed did change some of their language to, you could say, market perceived it to be less hawkish and more dovish. And that language went from being on autopilot and raising rates no matter what, to now stating that the Fed will be data dependent or look at the data. If inflation starts to subside somewhat, and they may back off, or some of the other data comes in differently than or more favorably, and maybe possibly showing potential for inflation to go down in the future, then the Fed may back off of their, you could say, uber hawkish tightening. And that was perceived by the market as an excuse to continue this rally that we've seen for the last couple of weeks here. So we could say, well, it feels like we're going into a recession, or we're already in one, and the markets are way down. Well, why does the Fed feel like they can continue to increase rates and tighten the money supply, whereas in the past they weren't so brave? Well, first of all, they didn't have the inflation problem in the past, so they felt like they didn't really have to worry about tightening too much. They could afford to be pretty easy and loose with the money. And the second very important reason, of course, is unemployment rate, which is one of their mandates, is full employment and price stability. So unemployment rate is at 3.6%, which is, as you can see, at near record lows. So if the unemployment rate is low, it means that, at least in the Fed's eyes, that everybody's working and the economy is relatively healthy, so that gives them an excuse to continue to tighten. Now, as you can see from history, when the Fed tightens, or when the unemployment rate is at its lowest, is right before these gray areas, which are recessions. And why is that? Because the unemployment rate is one of the most lagging indicators there are, and it usually is at its lowest. So most people are usually employed right before the beginning of another recession. And so the Fed is likely over-tightening into a recession, which means they may be tightening too much and will have to back off. And in fact, the market does expect the Fed, if you look at the futures market for Fed funds, the futures market is expecting the Fed to start lowering rates actually into early next year. Here's some charts. This is food for thought. The dark blue line is the total assets on the Fed's balance sheet. The light blue line is the stock market, the U.S. stock market, the S&P 500, which is a great proxy for the overall market. And as you can see, the two lines are pretty well correlated. And so when the Fed starts tightening or reducing the size of the balance sheet, that reduces liquidity, pulls cash out of the market, and you see the market eventually tank and meet the size of the balance sheet on the line. And they kind of mean revert to each other, you could say. And so now you can see that there was an announcement that the Fed will stop buying treasuries and other government securities and will actually start letting them mature off the balance sheet or even sell them off. And then you see a slight reduction in the size of the balance sheet, and then you've seen a huge sell-off in the market. So you could see maybe the sell-off is overdone. Maybe that's one of the reasons it's coming back to closer to the size of the balance sheet. Now these numbers are over very long periods, so this is just one factor that one could look at to try to see where the market could be going. And if we look here, this is also the S&P 500, and then you have the yellow line, which is the 150-day moving average. So from a technical standpoint, where are we? So if we look at early June, we had this big sell-off with a bunch of gaps down. Usually when we have these gaps, they backfill eventually, and that's what's happened. The market has climbed its way back up to the 4,000 range. And control this price range here, where you see a lot of action over the last since the beginning of the year. And so this is likely where there could be some fighting between the bulls and the bears to really parse out where this market is going to go. And so that's why we don't see a reason to become bullish yet. Certainly a reason to watch things closely. If we shoot past this 150-day moving average and past this 4,200, 4,250 on the S&P 500, then certainly the market may be seeing something that we need to look at more seriously in terms of reallocating towards more aggressive positions in the portfolio. As for now, we are relatively more conservative in our client portfolios as we watch and see how the economy continues to behave into the fall and into the late summer and then the fall. So if you'd like to discuss further or have any questions, you can reach us at the information posted.